We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Robert Sinn, investor, trader, and market commentator focused on precious metals, junior mining, and biotech with 21 years market experience. He's also the author of the Goldfinger Capital Substack. Robert, thanks for joining me today. How are you?
It's always a pleasure to be on Palisades Gold Radio. Thanks for having me on.
Excellent to have you, Rob. And of course, you and I have spoken before. And I'd like to kind of frame today's discussion by starting in a bit of a different way. You know, you spend so much of your time analyzing and understanding mining equities. And I want to kind of get your take on why you find this to be such an attractive part of the investable universe to focus your time on. And for those that might be, let's say, newer to this space, why is this a place that you focus so much of your energy?
It's a good question. It actually makes me think about it a little deeper. So first of all, the fact that I view gold itself, the metal, as being in a secular bull market, that's probably the number one reason why I focus on mining and specifically gold mining. If the gold price chart was going lower and in a major downtrend, and let's say the price was down to 1,500, I'd probably be a lot less interested in this sector. I don't think anybody would be interested, quite frankly. So the first thing is the view and the fact that we can assert just based upon price action that gold is in a secular bull market. That makes me interested. And I think the second thing is just that it's an underappreciated, unloved sector, and we can talk about why that is. But the fact there's less competition, there's less smart people and big pools of money that are interested in this space. So that means the opportunity for those who are interested and do put their attention on this space, it gives them a little bit more of an edge. Whereas if I'm trying to trade shares of Apple or Microsoft, I'm not likely to have any edge at all aside from just the overall, return of the market. I can buy Apple and I'll get the return of the stock, as long as I hold it, but I'm not really going to have an edge there, right? And there's a chance that Apple might be really overvalued now and it's going to lose market share possibly, or maybe China's going to kick them out, or who knows, and I could actually lose money, right? So the fact there's less competition in the mining space and the gold mining sector, more specifically, I think makes it a lot more interesting to me. And then also, I guess the third reason would be the fact that I've spent a lot of time on it. So I have a bit of knowledge, I have experience, I know the pitfalls, or at least I know a lot of them, and I know what I want to see in a company to maybe buy the stock. So
is there, let's say, a specific way that you think about deliberately structuring your portfolio into, let's say, percentages between majors, mid-tiers, and juniors or explorers for almost an idea of risk management and upside potential?
Well, I think just the market cap of a company matters, and the volatility of the share price, which, you can look at the chart and you can pull up, the average range for various time frames, and you can, basically, identify what the volatility is, right? So that is going to affect the allocation that I give that stock in my portfolio. So like if I'm buying Newmont, that's a big cap, that's a large cap, and the volatility is only so much because it is such a big company. It did have a big drop at the end of last year, but that's pretty rare for it to have a 40% drop in 2 months. So I might put 10% of my portfolio in that company because it's not that volatile. But a junior miner with a $40 million market cap, well, that can drop 70% in 2 months or even 2 weeks, right? So I might only want to put 2% or 3% of my portfolio in that one. So you just have to gauge it based upon your tolerance for the volatility and the risk of loss, right? And that's really, I think, the most important thing, as an investor is the way I do it is I think first about the loss. Okay, if I buy this stock now, what's the chance I'm going to lose money on it? and how much could I lose, right? And I try and gauge that, being as, I try to be, as objective as I possibly can, because obviously you don't want to lose more than you have to, and then size accordingly. I think that's very important. And a lot of people think about how much am I going to profit first, and I think that's the wrong way to do it. Obviously, you're only going to buy a stock if you think there's a good chance you're going to profit from it, or at least I hope so. But once you've, identified, I'm really interested in this stock and I want to buy it, then think about the loss and size, according to what the possibility of loss is and what the downside really could be.
Mm-hmm. So considering that, once you've done your due diligence on a company and you enter that position and it goes down, Rick Rule and I have talked about, if you already like a company and let's say it goes down by 50%, you should like it twice as much. Do you subscribe to that same idea of, once you have, let's say, done your homework on a company, that the price action being negative isn't actually a negative thing for you at that time?
Interesting question. I would say the time I see a lower price as an opportunity and I welcome it. The other half the time, I'm going to say, hold on, this is feedback I'm getting from the market. And while I think I'm pretty smart, I'm often not smarter than the market. Sometimes I am, but definitely not always. And so I'm going to look at that information. I'm going to say, what am I missing? And I'm going to ask myself, what am I missing here? Like, why are these shareholders selling and there's not as much buying right now, or at least the buying that's there is at lower and lower prices, right? So that means that the market is telling me the value of this company is less and less, right? So I need to really ask myself the hard questions there. What am I missing? What's really going on here? And then after evaluating it and trying to get a handle on those answers, if I feel the situation is unchanged or maybe it's improved, and the reason why the share price is lower is not really to do with the company so much, as it is to just maybe the sector is going through a rough couple months, or price of copper has dropped 10% or something like that, or there could be a lot of reasons why a share price drops, right? So, but you have to get a handle on it. And if I get a handle on it, if I'm comfortable with the answers and I still like the company's prospects, or I like them even more, then I buy it. I buy more. I'm happy to buy more. But at some point, you have to get to a point where I'm not going to argue with the market too much. It's like this dance where, I put 4% of my portfolio in it. It drops. Now, okay, I'm going to buy a little more. I'm going to go up to 6%. But am I going to go more than 10% if it keeps going against me? No, probably not. I'm probably going to cap it at some point. I'm going to say, hold on. The share price has to give me confirmation that my analysis is right. At some point, I need to get that confirmation from the price action. I cannot just keep buying a stock that just keeps falling. Okay, I think that's absurd, and that's a great way to just light bags of cash on fire.
Mm-hmm. Do you think that ends up being a more difficult task in this environment where we have such a cyclical market? There's been such a boon of capital to be invested from the general public for many of these, let's say, junior or exploration companies. So do you think those signals are muted in times of underinvestment and amplified in times of, a real bull market when money is rushing into the sector?
I think that market signals can become very skewed during, extremes. Mm-hmm. So during strong bull market phases, stock prices can get wildly inflated and almost have nothing to do with the fundamentals, on the ground, right? And so that's when, an astute, investor wants to be selling. You want to be raising cash, saying, okay, hold on, the market's, lost its mind, right? And we're seeing that in crypto the last several months. I mean, the fact that fart coin or shit coin or the jail coin can, make people millions of dollars in a couple of days. I mean, that's just pure insanity. And that's giving smart investor, an observer of markets, a signal that this is not healthy behavior, right? Going back to the flip side of that bear market environment, so maybe what we've had a taste of in the junior mining sector for much of the last decade or so, it can also skew the signals that when companies put out what is actually good news,
Mhm.
the market yawns because it's not as good as this sector needs to actually move the needle, right? So you need that 100 meters of 3 grams per ton gold to just blow people away to actually get the share price to appreciate. If you get a drill permit or you drill a decent hole, people just yawn. Like, okay, so what? Like, show me the money, right? And so for a smart investor, that's great because it means that you're not overpaying. You're actually being able to get value for your money. You're actually being able to buy companies and projects at fair valuations or maybe even, God forbid, cheap valuations. Now, that's obviously strongly open to interpretation, what is cheap, but at least you're not having to pay up. And as I said at the start of the conversation, there's no competition for your money,
Mhm.
right? So you're able to buy what you want and you're able to buy it at fair values, which in a bull market, absolutely you cannot. You're going to have to pay up and you're going to have to chase it. And companies are going to maybe even turn down your money because their financing is oversubscribed and you're just not that important to them.
Or not a big enough fish in the pond.
Exactly. Yeah.
So as you're mentioning this idea of, a company coming out with an amazing hole, or a company coming out with a permit, announcing that they've received a permit, this makes me think of the Lassonde curve and where those companies actually are in their life cycle going into from, let's say, exploration and striking a big drill hole into that capital intensive, let's say, low part of the cycle and back up into the higher share price into production. Do you focus any of your efforts on a specific part of the Lassonde curve?
Yeah. So I want a new discovery, Tom. Like, I want to see a company drill a hole or several holes that really lights the world on fire and
Mhm.
gets the market excited, right? So that's where I play a lot. But also, the construction phase, companies ramping up to actually having a mine, cash flow. They're exchanging gold in the ground for, money, which is sort of the point of all this, right? So that's also a very interesting part of the life cycle of a mining project and of a mining company to me. The period of permitting and feasibility is sort of the dreaded period. It's like the death valley in the mining life cycle, and that's a tough one. But I know that you mentioned Rule, and Rick loves that period, that feasibility period, because he thinks that the market makes these stocks very attractive during that phase because they usually the share prices drop and they're unloved and people aren't focused on them, and that could also be a sweet spot, sort of to buying it towards the end of the feasibility and permitting stage. But I like the excitement of finding something new and all the excitement that can bring to the sector and bring to a company. And it's also it's psychologically a very interesting stage, in the sector because it's sort of the pie in the sky stage where you don't have a lot of drill holes yet. You've got some, but it's where people let their imaginations run wild sometimes, and valuations can get a bit frothy. And so that's a nice time to sort of fade the crowd and all the excitement and actually take profits and then wait to see if it's really going to be that good, right? And most of the time, once the company has a couple of great holes and they catch the excitement of the market, they're not able to continue those good results for very long, right? Because it's just you're not going to hit on every hole, right? So they hit maybe 2 holes, 3 holes, get everybody excited. And then maybe the next 5 or 10 or 15 holes don't match up, right? And so you're going to have a big share price drop normally during that period where they're not able to match those first few holes, into a new, new discovery.
Mm-hmm. Going back to this idea that you mentioned about, let's say, competition for your money and competition within the gold mining space right now, when we consider the potential upside of gold and the gold mining complex, is the first step starting with seeing how underowned gold and the gold mining complex is compared to the rest of the markets? This historic percentage is at less than 1% right now, versus historically we've seen periods of up to 30% of the, let's say, the general market cap of the investable universe being upwards of 30% invested in gold and gold mining equities, right?
Yeah, I mean, in the late 1940s, gold and gold miners were like 30% of total, assets across the globe. And even in 1980, 1981, they were, a quarter of total assets across the globe. So the fact that we're now under 1%, well, it's a sign of the times, because tech is obviously a bigger and bigger part of total assets, that are out there held by the investing public. But it's also just shows you how deeply out of favor the gold sector is and gold miners are. The fact that gold is at an all-time high. I mean, we're $2,900 an ounce here as we speak. The price of gold in every currency essentially has never been higher than it is right now. Yet most investors don't care. I would say 99% of investors simply don't care, and they have no exposure at all to gold mining, et cetera, right? And so therein lies the opportunity. And I think that some of what's happening out there today in the macro landscape, quite frankly, is telling us that gold, despite the fact that we have all this technology, we have the artificial intelligence. Obviously, that's getting stronger and stronger every day, but gold is not going anywhere. It still has its place in the world as the timeless store of value with no counterparty risk. Central banks appear to want it more than ever. And China has been accumulating an incredible rate since 2022. And a lot of China's accumulation is stealth buying. So for those investors who actually are paying attention and understand these forces that are moving across the globe, I mean, it's almost like this is an opportunity that I've never seen in my lifetime. Sure, there's been good times to own gold. There's been bull market phases. Obviously 2009 to 2011 was a great run. We had a good run in 2020, but those were cyclical bull market runs that fizzled and faded out. But this is like, nothing I've really seen previously. And the fact that the gold mining sector is so underowned and so underfollowed and so underappreciated, I think it's a tremendous opportunity for those that are paying attention and do understand the opportunity.
Mm-hmm. I do want to get to China and specifically other central banks and their ownership and appetite for gold right now. But before we go to that subject, I want to ask you if we're solely, dependent right now on gold producers' earnings and free cash flow generation to come out as a contrast to the rest of the market. And that is kind of the catalyst that ends up serving to bring interest back into the gold mining complex from the generalist investor.
I think it's necessary to see good earnings from the sector and costs coming back into line and not increasing by 10% a year. I think it's important, but a rising gold price is powerful fuel, because even if the costs are going up $1,500 an ounce or $1,600 an ounce or $1,700 an ounce, $2,900 is still way above the cost to mine the stuff, extract it and sell it to the Swiss, right? So the sector is incredibly profitable, but I think for this to be a bull market that gets the general public involved, we're going to need to see strong quarters from the big companies like Barrick, like Kinross, et cetera, et cetera. And they're reporting like right now, like for the next 2 weeks, we're going to get the quarterly results from the gold mining sector from all the big companies, and it's going to be really interesting to see what the results are. I mean, I'm pretty optimistic. I wrote an article in my Substack that I think that this quarter and the guidance that these companies put forth here in the next few weeks could set the sector on fire, quite frankly. And I mean that in a good way. I mean, it could really be powerful for the sector. We've got a few conferences that are coming up as well. And I expect there'll be some mergers and acquisitions as well that will be announced, on the back of those conferences. So it could get very exciting, Tom, here over the next couple months, in the gold mining sector.
Mm-hmm. What characteristics should the uninitiated, let's say, start looking for if their interest has been piqued into this area? Is it a balance sheet with relatively low debt? Is it projects only in specific jurisdictions, profitability and cash flow, or a strong management team that you have confidence in?
Profitability, number one, you want to see more growth. You want to see companies that are growing, right? So maybe they generated 500,000 ounces of gold last year. You want to see them get up to 600,000, have plans to get up to 700,000 ounces. You want to see them growing. So you don't want to see this stagnation at 1 million ounces or even dropping to 900,000 ounces, but you want to see profitability first and foremost. So profitability is more important than size. Okay. You want to see what's the margin per ounce? What's the free cash flow the company is able to generate? And are they growing? Right. So those are the most important things for me. I also take a look at the balance sheet. So debt, cash on the balance sheet, just making sure that they're not trying to run their operations on a shoestring, right? And then look at the pipeline. So this is a little trickier because most people are going to just look at the operating mining operations and how they're doing. And obviously that's really important. But then also what's the pipeline, right? So what are the projects that they have sort of, that are ready to come forth in the next 3, 4, or 5 years? Because the problem with mining is that as they operate these mines, they're getting closer and closer to the terminal date where the mine is out of ore. There's no more gold to extract, right? So you need to make sure that if you buy a mining company, that they have a strong pipeline and they're going to be able to continue to grow.
You mentioned this, possible wave of mergers and acquisitions. Does that kind of mark a pivotal time in the gold cycle because of, let's say, the ability of that becoming a trickle-down effect from the big producers to the rest of the, let's say, the mid-tiers and the junior/explorers?
Yeah, I think that what it means is it could mark a turning point for the sector where the juniors participate and maybe even start to outperform. And so that's one of the reasons why I think it's important. But also just broadly speaking, it will basically mean that companies are using their cash that they've been hoarding the last couple of years. I mean, if you look at the balance sheets out there, it's a lot of cash out there in the sector. There's a lot of cash on the balance sheets. And then also share prices have gone up. I mean, I know that Barrick has not had a great last couple of years, and some of the other big ones have not had a great last couple of years, but still a lot of share prices in the sector are at 52-week highs or all-time highs. So there might be some cash acquisitions, but there could also be some part cash, part stock. But either way, it means that the money is flowing through the sector. And when buyouts happen, it means that people get cash or get stock that they can sell, and then they can reallocate that across the sector. So it's just good. It's a strong tailwind for the sector, as a whole. So it's good for a number of reasons, but also it will start to trigger the animal spirits that, oh, okay, hold on, maybe this junior that I've been holding for the last few years, it's finally, its time has come to possibly be acquired, or at least to be revalued higher as some of its peer group, starts to be acquired.
Mm-hmm. Something that we kind of touched on before we hit record here today, and which I think is an interesting idea, is not actually looking at the GDX to understand or to get a good feeling of what's going on within the mining sector. So tell us a bit more about why you don't think that that's a good signal.
So the GDX, the number one and number two gold mining companies, account for basically a quarter of the index, right? The exchange traded fund that everybody quotes. So I think that is not, very accurate of the whole sector. So just because the two largest caps are such a focus for, the ETF, I don't think that is an accurate way to gauge the sector more broadly. So there's a bunch of companies that doubled in 2024 or even more than doubled, in the last year. And so you have to drill down and you need to really look across, the sector as a whole to see how, the gold mining sector is actually doing. So we don't want to just look at Barrick because it's a big company and it's a big part of, of the ETF. We want to really look broadly, across the sector and see the companies that are actually, doing well and not the ones that are having problems in Africa or having cost overruns at, a couple of their operations, right? So the companies that are smaller, a little, leaner, and are able to actually grow.
So, Rob, when we think about, let's say, other things that make a company more attractive to you, do you start to look at polymetallic deposits, like let's say a copper project that has a significant silver offtake from it as well? Is that something that is more appealing to you?
Honestly, I think that it really depends upon, the body and the economics of the ore body. I don't really care if it's copper, silver, lead, zinc, gold. That doesn't really go into my calculation a lot. But if I have a positive outlook on copper and silver and gold, then obviously I want to focus on those assets. And I think copper right now is extremely interesting. And even at $4.50 a pound, which might seem high, compared to where it's been the last 20 years, I still think that's a very low price, compared to where it could be 5 years or 10 years, down the road. So for me right now, the two metals that I've been focused on and I continue to focus on are copper and gold. And, I love to see a porphyry that has both copper and gold. But, at the end of the day, it's really about the ore body. And if it's just all copper with just a smidge of gold or moly, that's fine. If it's copper with a lot of gold, that's fine too.
Mm-hmm. What about investing in royalties and streamers, Rob? Do you find that is an attractive business model for what you're looking for?
I think that's a great model for an investor. It's just a way to simplify it. Takes a lot of the homework out of the equation, and the volatility is a lot lower in the royalty companies. But for me, it's just not as interesting. So it's a little bit boring, but definitely it's a tried and true way to have, strong returns, in this sector.
Mm-hmm. Let's back out a little bit and understand a bit more about, let's say, the macro backdrop for gold here. Obviously right now we're speaking in the middle of February. There's been all kinds of, let's say, threats of tariffs launched against many countries around the world from the US and from the new administration. So how do you think that ends up really affecting gold specifically at this point and going forward, let's say, for the next 2 or 3 years?
This is a very interesting topic. And I think that we have to look back to the last 5 years and think about this is the fourth turning, right? That's a book and it's a topic. You can, for those who want to learn more about the fourth turning, you can search it. Basically, we're at the end of the fourth turning, and most likely the end started sometime around 2020, which we know the COVID pandemic and all of that occurred for a couple of years. And now we're getting towards the end of the fourth turning, which some people say it's 2025 is the end. Some people say it's 2030. Some people say it's 2033. But either way, we're either at the end or we're in the final years of this period that we can call the fourth turning, and then we'll get to the fifth turning. But the end of the fourth turning is a crisis. Like, we're in a crisis period across the globe. And I think we can all agree that we're in a crisis period. We've probably been in a crisis period since 2020 with the start of COVID. And the election of Donald Trump, the war in Ukraine, these are all symptoms of this crisis period that the world is going through. And I would assert that the COVID pandemic was the appetizer. So it was like the prelude to the real crisis. And I don't want to scare people, but this is, what I think. And I've read a lot about this. I've thought a lot about this. And I think there's strong evidence right here, right now, that we are about to enter a bigger crisis period that could last for a couple of years. It could last for 5 years, but it'll mark the end of the fourth turning and the transition from this phase of crisis to maybe a period of peace and a more stable world. But we have to go through some real pain to get there. And I think that's where we're at right now. And so it's no accident to me that the president of the US is this guy, Donald Trump, who's a very controversial character. He does things his way, not the standard way that presidents do things. I think we can all agree on that. And the tariffs, the threat of tariffs on Canada and Mexico, supposedly our two biggest allies, or two of our biggest allies, are, again, a product of his brand, which is different. He's just a different character, and he likes to shake things up and do things that are out of the ordinary and say things that are out of the ordinary, like the Gulf of America, like Canada as the 51st state, right? Just to ruffle feathers, rub people the wrong way. And maybe he thinks it's going to give him an edge somehow, right? And so I think Canada and Mexico are an important part of this shaking things up. But really, the main event is China. The main event is China. I mean, obviously, Canada's important, big country, big border to the north, lots of metals and oil and natural gas in the earth. And, we can all appreciate that. But China is a much bigger economy, much more important trading partner. And it's the trading partner where the U.S. has the biggest deficit, right? We can all agree on that. That's a fact. And so I think what's about to happen here is Trump and Xi sitting down and sort of reshaping the world economy, right? And the two actors, the president and the chair, are just getting warmed up for this next part of the play. And I think what gold has been doing is a symptom of what people see coming. There's risk, and there's also possibly a reshaping of the world economy, world monetary system even, right? Some people call it a reset, right, that could be coming. And gold is clearly going to have a role in this reshaping of the world economy. And China has been preparing. So even if you don't agree with anything I just said about the fourth turning and the crisis and Trump, blah, 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 at least you can look at the facts of what China has been doing for the last several years, all the accumulation of gold, both the official buying that they report and the unofficial stealth buying, which they don't report, but which there's strong evidence has been going on. They've been accumulating thousands of tons of gold, and they continue to accumulate it. And their footprints are in the chart and in the price action, right? On days when gold is supposed to be down because of whatever, the CPI or the Fed or what have you, it didn't go down because China was on the bid, right? And so really it's figuring out what is China's plan here? Like, what's the end game, right? And I think that's a very interesting thing to ponder and be in the question of.
One of the other, let's say, central banks that you recently mentioned in one of your weekly videos on your Substack was India as well. What has their appetite been like for gold over the last couple of years?
Enormous. I mean, the population, I think, like with all the Asian cultures, they have a strong appreciation for gold, okay? And they love gold, and they love gold as their main form of savings. And so there's been just a lot of buying of gold from the people across Asia, whether it's Vietnam, Thailand, China, or India. There's been a strong accumulation of gold, including by the central banks, and perhaps first and foremost by the central banks, and not all of it has been reported. So there's been this sort of stealth purchasing going on from many central banks. And so you have to ask yourself, why would major global central banks be carrying out a stealth gold buying program, right? And I think that's a very important question that all investors should ask themselves and try to unpack.
What do you make of the situation with the LBMA and their, lease premiums going up and all of a sudden the delivery times just blowing out for the gold? Like, do you think that that's just vaults trying to get ahead of these tariffs to get more metal into the country, into the States?
Yes, and yes, and yes. I think it's a symptom of many things. One is it's a rush for physical in the US, ahead of tariffs or possible tariffs. I think it's also a bit of a short squeeze that has been playing out. I mean, we got to think back, Tom. I feel like I'm a gray beard in the gold sector now, but I know there's guys who are way grayer than me. But thinking back 20 years ago, I would read these guys talking about, oh, there's going to be a physical short squeeze. Like the bullion banks are short all this paper gold, right? And then I read that same story on repeat for 20 years. Mm-hmm. And I was like, these guys are all quacks, right? They're just nuts, And it never really happened. We got a taste of it in 2020 with the pandemic, and that was obviously due to that whole mess that you couldn't move stuff around the world for 2 months. But, we got a taste of it, but we never really got it. But now, with the world's biggest central banks on the bid and vacuuming up gold bars, it's actually happening. Mm-hmm. Right. So it was kind of a crackpot story where everybody got the timing wrong for 20 years. But now it's actually happening because the biggest players are on the bid, which didn't exist previously, right? Like back in 2015 or 2010, a lot of central banks were still gold sellers, right? And so it's flipped, like they flipped the script. And so it's actually happening. So I think you have gold being vacuumed out to the east, largely by China, but also by a few other central banks, across Asia. So that's a big bid that's in the market. And then you have Trump, who's this big monster in the room, just shaking up the world. And everybody's afraid of the tariffs or trying to front run the tariffs, or they're even not sure what his plan is for gold, that maybe there's a Trump plan for gold, or at least to revalue the gold that the Fed has to current day prices instead of having it at $42 an ounce, right? But there's probably more than just that. He's got more plans than just that. And there's even some speculation that maybe the US government is going to, resume its purchases of gold, right? Now that's mere speculation at this point, but it could happen, right? And so you just have, who wants to be short gold in this environment with all the uncertainty? And, by being short gold here, you're basically saying that you're betting against the People's Bank of China. Like, no, I don't want to make that bet. Like, that seems like a really stupid bet to me.
Yeah, it's an interesting situation to think about and consider in that way for sure. So, Rob, do you think that let's just say hypothetically, we do have a physical short squeeze happening on gold? Who knows, what the outcome ends up being of that, but we've seen it, played out over the last, let's say, year. Does that start to extend into silver and the rest of the commodity complex?
I think it does, but maybe to a lesser extent. I mean, I think it was it Tuesday? It's Wednesday. So I think it was Monday night. Gold was running to 29.50, 29.60 overnight. And I saw the silver futures were basically just stagnant, So I'm like, no, like this is gold. This is a rush for gold. And central banks don't buy silver, right? So this is a central bank thing that's happening in gold. Will it eventually feed down into silver? I would say likely yes, but that's going to be later in the game. And then it's going to get closer to the end of the run for gold. I mean, like, we could say gold is in a secular bull market. Gold is still going higher. Eventually, I think we can all agree it will get to a price that is high enough, and it will have to have a pullback for many months or maybe even a year, right? But I don't think we're there yet, and I don't know what that price is. It could be 3,300, it could be 3,500, it could be 4,000, but it's higher than where we are now, right? And so for silver to have that vault to 50 or 60 or 70, I think that'll be closer to that sort of terminal price for gold, and I don't sound bearish by saying that, but frankly, at some point, I think we can all agree that things get to a price where it's too high, right? And so we're not there yet, but silver is just like the junior mining stocks move in the 8th inning or the 9th inning of the bull market, right? I think the same goes for silver. It starts to move in the 7th inning or a bit later.
Mm-hmm. Yeah, there does certainly seem to be some stepwise progression to a lot of these markets in the way that they attract capital.
Mm-hmm. Yes.
So, Rob, all of this being considered, let's say this macro picture, is that something that you spend a lot of time thinking about, thinking about what's happening with the national debt, thinking about what's happening really with the central banks stacking all this metal or having such a big appetite for this metal? Or is it that you understand, let's say, the bigger macro picture at this point, what the outcome ends up being of that, and so you end up spending your time focusing on the actual ways to create capital out of that by spending more of the time focused on the equities rather than this macro picture?
Thoughtful question. I would say, first of all, I did spend a lot of time thinking about my macro framework. I spent a lot of time, like 2 months ago, pondering the Trump tariffs in China and what exactly China's response to Trump is going to be, and why the PBOC has been so aggressive with their gold accumulation. I spent a lot of time thinking about those things and putting together a framework. And so maybe once every couple of weeks, I check back in on that just based upon the events, which seems like we're getting fire hose of news being thrown at us now the last several weeks. But I do have to check in on the framework and make sure that I still agree with it, because the macro is in flux and it can change. But once I've become comfortable that I think I've got it, and the events that that are unfolding are giving confirmation of my thesis and my framework, then I focus more on the micro. I focus more on charts. I focus more on trade setups, and I focus more on fundamentals of companies and what to do. What am I adding to my portfolio? What am I taking out of my portfolio? And trying to come up with new ideas, right? And it is literally a full-time job. So being an investor and then a commentator as well, a blogger, a commentator, and making content that people actually want to watch and read is a full-time job. I mean, you're talking about 60, 70 hours a week, right? This is not a thing for a lazy person. And then to actually really think deeply about some things, right? To actually go past the headlines and the sound bites and actually really trying to understand how the world could reshape over the next 6, 12 months or so. That requires some real thought, and it requires trying to get some ideas from people smarter than me, reading and just thinking about it and processing it. And it's like, okay, so what's this going to look like a year from now? How could it play out? And then also just being in the question that I don't know, and I can't know the future, but I can have a pretty good guess, and then I can take new information as soon as it becomes available and put that into my framework and see, okay, I'm going to have to change this.
Mm-hmm. So is there something that you'd like to leave our listeners to think about, or let's say a source of information that you kind of keep coming back to be able to plug into that framework that you find is quite valuable?
I think reading The Fourth Turning And thinking about that subject, that the world changed following the Second, World War, 1945. They reshaped the financial system, with the U.S. as the leader, the dollar as the currency that the world would basically use and fall back on for trade. And then what happened like every decade after that, and how the world has evolved since 1945. And now where are we today at the end of this period? At the end of this period that started in 1945 with the peace that came after the war ended, and really appreciating that we are in a crisis, whether we want to admit it or not. There's a lot of crisis out there, and things are very much in flux. And so gold is a bastion of strength and timeless value in a sea of uncertainty and flux. And I really think that's the important thing for people to appreciate. And that's why gold is appreciating, because it is this bastion of stable strength and timeless value in this crisis period that we are in, and that is likely to get more uncertain and more volatile for some time to come.
Well, Rob, I couldn't agree more. That was really, really well put. And I think that's a good spot to kind of wrap up on. For those that want to read more of Rob's work, again, all available at Goldfinger Capital on YouTube, Robert Sinn with 2 N's on Substack, at Goldfinger on CEO.ca, and of course, Twitter as well, at CEO Technician. Rob, thanks so much for your time today. Really appreciate it.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.